where central banks' approaches to blockchain and crypto. Some, I would say a majority, are monitoring, studying. The US Federal Reserve would be this way, the European Central Bank. Rob has a better feel because he talks to central banks all the time, but monitor and study is the dominant place. Restrict its use. I'd say the People's Bank of China is more towards this. They're kind of a mixture between monitor and study because one of the readings was actually from a senior policy person at the People's Bank of China. He's written some remarkable pieces. Every few months there's a piece in like CNN or CCN, which is a crypto newsletter, or Cointelegraph, that this one individual from the Central Bank of China is writing these pieces. Now, I don't know a lot about the Central Bank of China. He always puts at the bottom, these are my personal views, but I have a suspicion he would not be allowed to write these things if it weren't something bubbling underneath. But you can restrict the use of crypto, and some countries like China and elsewhere are doing that. There's payment system experimentation, which we're going to chat about. And then there's this thing called central bank digital currency initiatives. And Rob and I know the answer to this, but I'm curious of the group. Central bank digital currency, having read all that you've read for today, does it rely on blockchain technology? Show of hands. Yes or no? So yes, it relies on, my hand won't matter. Does it rely on blockchain technology, central bank digital currency? I don't see a single hand. How about no? How many people think no? Well, you did your readings well. You did your reading. Thank you. She's Simon. So central bank digital currency is inspired by this whole crypto finance movement, but it does not necessarily depend upon blockchain technology. But I think it's central to this course and central to a study of blockchain technology and money, because it's absolutely inspired by this whole movement, though the first person that wrote about it was Tobin in the 1980s, if I'm right? Do I have, yeah. Yeah, 1987 or something, I think. Tobin wrote about basically giving the public a direct tokenized means beyond paper money, a digital means of an account. But most people would say central bank digital currency relies on blockchain technology, and you've made me proud that you said no. Let's talk about the pain points. This was last Thursday's lecture, but there's some payment system pain points. I added one or two because of your feedback, but cost, delayed settlement, chargebacks, frauds, privacy, financial inclusion, and the like. And for Rob and Simon, this was last Thursday's discussion. So some of what the public sector is doing is non-blockchain initiatives, entirely non-blockchain initiatives. The European Union, the US, others are doing things about faster payment. Basically trying to move the payment system to 24 hours a day, all 7 days a week, not locked up on the weekend, where you can actually move, and that merchants can do it as well as banks. So whether it's the Target Instant Payment System, or what's known as TIPS in Europe, or Faster Payment Task Force, which has led to a faster payment mechanism. I think, I'm guessing Priya's husband's working on that, right? Does he? He was working on the task force? Shreem joined us last Thursday, and he talked about, he's at MasterCard. So a lot's going on. I just note, I put just two other countries. India's immediate payment service is really government-sponsored, government-pressed. I think one of the gentlemen that works on it, Simon, you have speaking at MIT's campus in a few weeks. Arvind worked on it. And in the UK, where they're saying, not only are we updating our real-time gross settlement system, but there's a government mandate that banks have to open up their bank accounts to what's called Open API. A lot is going on non-blockchain related to payments, making it faster and more access. But in the midst of that, here's a little bit of what's happening in the blockchain space. And with the help of the South African white paper on this. I break it into 3 phases, so I thank South Africa's central bank. First is phase 1. 3 countries wrote papers, Canada, Brazil, and Singapore. Canada and Singapore even called them something. It's called Project Jasper in Canada and Project Ubin in Singapore. And they did some experimentation all based on Ethereum network. Could you do a better payment system based on Ethereum? So an open source blockchain permissionless system. And they tested out a new real-time gross settlement system. And they generally, the way they do this is they get a group of banks in their country. And if you were to read each of their detailed reports, there's some similarities and some differences. But by and large, get a group of banks in your country, use the platform, try to do a talking through and see if it will work. Aline.
So they built a permissionless system?
They were trying to see if they could use the Ethereum network to build a better payment solution.
Or are you saying they developed a smart contract on the current Ethereum? Or did they deploy their own Ethereum permissionless network? Which one did they do?
I think it was, they just cloned Ethereum and deployed it like internally. It wasn't like ever outside the walls.
So they were doing mining?
I don't know how they did the consensus mechanism.
Now what you'll see, because I want to quickly go to phase 2, phase 2, none of them used Ethereum. Phase 2, two more initiatives happened, Japan and Europe together. And when I say Japan and Europe, I mean the central banks. And all of these are central bank focused. Japan and Europe added, and South Africa. And all 5 initiatives, all have been published already, were happening in those various states in mid to late 17 and into 18, were all on permission. They were looking at Corda, Hyperledger Fabric, and Quorum. Quorum is the closed loop system that JP Morgan. We talked about Hyperledger Fabric and Corda. So I think, Aline, this kind of starts to answer your question. That they then said, well, no, it's not going to work on a permissionless. Every one of them in phase 1 said, we don't think this is going to work on a permissionless system. Let's then go into a phase 2 experimentation. We're now in kind of phase 3, or a third wave. We haven't heard from Brazil recently. Don't know whether that project is basically stopped. But these are big countries and big central banks that are interested is, can there be a payment system solution? So I'm just going to talk about Singapore for a minute and give you a flavor for outside of the readings, but a little bit of what the Singapore project is. But it captures all of these by just talking about this project. This is from their papers. But they really see that we're in a multi-phase project, and they're willing to publicly say, we're going to go further than where we are right now. We want to get to the place where we have domestic delivery versus payment, and in the future, payment versus payment systems, money versus money. Delivery versus payment, DVP, is basically a security versus money. So if you see the words DVP, it's in the securities business where you move a security and a payment simultaneously, and there's no credit risk. I will not give Rob the security unless he gives me the cash, or vice versa. Ask me one day about when, before we had DVP, what the markets were like. So Singapore is willing to publicly announce, we're going to take this as far as we can go, all the way to a cross-border settlement of payments and securities against each other. D versus P is what they call it. The D you can think of as securities. Will they succeed? Do they need to stay on a blockchain? I can't predict that. But they're willing to say, we're going to give this a try. Where are they right now in phase 2? Well, they tested Corda, Hyperledger Fabric, and Quorum. And they have a full 60-page report they published a month or 2 ago about how did each of them work to do basically payment versus payment, cash, large cash movements. But here are the 6 criteria they tested, and they say they passed every one of them. Now, I read the full report, and I have to say it struck me that they probably did pass it, but I'm not enough of an expert. and this stuff gets very granular, and the question still is, could you just use an Oracle database to do the same thing? And it's a fair question. But they tested it basically, can you digitize the payments? Can you decentralize the processing? Can you do the queuing of payments? And a lot of cross-entity payments, you have to net the payments. I'm going to pay Rob, Rob's going to pay Hugo, Hugo's going to pay me. Well, that doesn't make sense. You net it all, and it's a queuing factor in all these real-time gross payments. Aline.
So what does decentralized processing mean here? So this was in what country? Brazil?
Singapore.
Singapore?
Singapore.
So there's a central bank in Singapore. It's clearly very centralized. What does decentralized mean?
So to them, and what they write about, they think that you could lower the single point of failure risk by not having the central bank. They actively, this is a central bank writing the paper saying, we could have more resilience in the system if the database is distributed amongst, in this case, they had 11 banks participating. And the 11 banks have separate nodes. Now, it's still a permissioned system. You might say, and somehow the central bank has a notary node, maybe, but it's amongst the 11 banks, and that there would be more resilience to the system than having it centralized.
And the central bank still does monetary policy.
Central bank still does monetary policy. Rob, what do you want to add to this? Because Rob swims this lane, I don't.
Yeah, I mean, I think it's one of the big challenges, right? Because the question of like how much the central bank consciously limits its own power, I think, is important, because if you have a system where, because I think that there is an instinct, certainly with some central banks, they want to maintain control of the system. They're like, well, okay, but we want to have like a special node for the central bank that can do all this, that, and the other. And my argument to them is you actually want to limit the power of the central bank as far as you possibly can, because to the extent that the central bank has special powers over the system, that creates a weakness in the system, because if that node is then taken over, then whoever can go and change the system has effectively all the power of the central bank, which sort of takes away the benefits of decentralization. If there's, because to my mind, the point of decentralization is increasing the cost of the attack by saying, well, to attack the system, you have to attack 50% of the nodes in it or whatever. But if you have this one special node that can do everything, then you only have to attack one node, and it sort of defeats the object. So I think when you're speaking to central banks, you have to persuade them of the need to have a system that they like almost set it up and let it go, rather than have to continuously interfere with and have to have these special powers over it.
What's interesting with so many countries, there's going to be a wide variety, and I really do think that many of the central banks are in that monitor and study slipstream, and a couple are in the let's restrict the use slipstream, and even China that says we're restricting the use is still studying the heck out of this. But some countries like Singapore and Canada are in the forefront saying, let's figure out, maybe this technology will make the payment system and thus the system of fiat money more resilient. It's still unknown, but they're really trying to test the edge.
So perhaps this is just like a peculiar observation, but I feel like the very institutions that Satoshi and Bitcoin were trying to disintermediate are the ones that are taking inspiration from this and then trying to advance their own technology. And it feels, is it a competitive threat? Like, what's the disconnect? Like, how are they thinking about using this for something that was basically built to disintermediate them in the first place?
Remind me your first name. Zahn. So Zahn's asking about Bitcoin, and wasn't Satoshi Nakamoto's innovation about doing something not just decentralized, but not trustless sort of system. But every technology evolution, whether it's in electronics and telecommunications or elsewhere, startups, if they have something good, incumbents will look at that technology and see what to adopt for themselves, partly because they're threatened by the startups. And in this case, I really do think central banks have felt a little bit of heat on their neck. A little bit of heat, like we've got to think about our payment solutions and our money solutions, and maybe there's something from blockchain technology. But regardless of whether it's the heat on the neck or opportunity, incumbents will always look at technology and see. And that's why the paper that you've read sometimes, the Geneva report that Simon and 3 of our colleagues and I co-authored this past summer, we called Blockchain Technology a Catalyst for Change. And we were agnostic partly because there were 5 of us co-authoring it. But we felt that captured our 5 points of view, that it might be a catalyst for change for incumbents. It might be a catalyst for change to inspire central bank digital currencies, which frankly don't have to be on a blockchain at all. Or it might be some startup that does really a unique thing, and I mean unique beyond crypto kitties. You know, something more than that. Aviva. I know you, Aviva.
So I was just curious, are there details about the timeline for this in the sense?
Say that again?
Are there details about the timing for like how long it takes to process a payment by the central bank, like all the way to settlement vis-a-vis fiat currency?
So a timeline for, so not the study, not this timeline, but you're saying a timeline for?
No, but that's specific for this specific project and the 6 criteria that they defined. Have they also said?
I'd have to look back. It's a good question. I don't think Singapore has said they're going to finish this by 2019, but I don't know whether they said a date like 2021 or 22. But it's a multi-year project.
For a specific transaction to process it all the way to settlement, how long it takes?
Oh, the test case in Singapore and Canada within seconds, but I don't know if it was like nanoseconds. No, it's very quick.
I have another question for the 3 of you actually. How is the central bank thinking about reporting for these transactions? Or is it a later stage problem to worry about?
Well, the reporting, as I've read these reports, and then I want to move on to central bank digital currencies, which we're going to be largely talking about Thursday, but I want to set it up because Rob won't be with us Thursday. Reporting is, this is a ledger. This creates a database, this permission blockchain amongst 11 banks in Singapore, and it was just a test, is basically a form of a ledger. So I don't think they built out any customer user interface and reporting that way, but the transaction ledgers were kept similar to bank ledgers as I understood it. But they didn't build out a user interface. Unless, Rob, you know any otherwise. No. So let's talk a little bit about the next and the toughest, central bank digital currencies that may or may not be based on blockchain technology, but they're absolutely inspired by blockchain technology. So central banks currently issue digital reserves. We saw that earlier. It's digital money already. And then physical tokens. I keep my eye on this physical token here, right? So that's the form of money. Commercial banks then issue bank deposits. In the US, that's about $13 trillion to the public in bank deposits, and there's only 1.7 trillion of this. So bank deposits are the biggest form of money, and it's all digital. Essentially, bank deposits are intermediated central bank digital currency. Those are my words, but it's digital currency bank deposits. It's just not directly with the central bank. It's intermediated in between. If you sort of go back to that flow chart that I had earlier. So the private sector is also experimenting with stable value tokens. We're going to talk about that Thursday. There's some readings. I'm not going to dive in now. So there's a little bit of competition. So it's like Zan's earlier question. The private sector, Circle and Tether and others are having these stable value tokens. So there's a little bit of competition coming that way. So the strategic question for the central banks is, should we allow direct access to digital reserves? We have this intermediated central bank digital reserve called bank deposits, but should we have something direct to us? Like cash is a direct relationship between the central bank and the holder. That's really the strategic question when you, I believe, when you move away from the technology. You don't have to know about hash functions or anything. That's the strategic question. Why do I think there's some opportunities? And we're going to dive more into this Thursday, but I want Rob to see if he wants to speak about this and tell us. I think this is a real question, and Sweden has highlighted it. They want a continued involvement in the means of payment. Sweden is already down to about 2% of GDP, or 1.5% of GDP is their kronas, the physical kronas. The U.S. is still at 8 or 9%, but they're saying nobody's accepting physical kronas anymore in Sweden and Norway and so forth. Pretty soon, most retailers will not take them. So they're saying maybe the government needs to have a continued direct relationship. Could it promote competition in the banking system? Because otherwise, if you don't have it, then the banks are controlling the payment system and the means of payment, promoting financial inclusion. Not everybody will have a bank account. Well, maybe they could have some digital form of central bank money instead of a bank account. The pain points, and I would say for some countries are clearly looking at central bank digital currencies to avoid U.S. sanctions. Venezuela and Iran both have projects for central bank digital currency. Sorry, question? And so here of course, blockchain technology could be relevant. For these 6 reasons, or 5 reasons, you didn't need blockchain technology. But I'm going to say blockchain technology could be relevant. Fiat currencies on a ledger, verification and networking costs are critical to the economics of money. So I wouldn't count blockchain technology out of this, because blockchain technology can lower verification and networking costs. But I think we're too early to know whether blockchain technology will be at the center of central bank digital currency. But it could have an effect. So the challenges, and again, we'll dive more of these Thursday. Rob, you want to say anything about these challenges?
Yeah, I mean, I think Ben's speech was good on...
Ben Broadbent's speech.
Yeah, Ben Broadbent's speech was good on outlining this. I think the fundamental one is this: how do you fund productive enterprise in the real economy, right? That's the real... How do you fund productive enterprise in the real economy? And at the moment, certainly in the UK and Europe, and I guess to a lesser extent in the US, but it's largely true for the US as well, is that you're very much reliant on bank lending. And if you do something which essentially drains deposits from banks, are you like fundamentally changing the nature of the system? And how are you going to create a system which allows people to like fund mortgages or fund businesses or whatever it is? And I think that's the big challenge. So I think that's like the central question, which I think is the bullet 3, effects on credit allocation and economy, is the thing that I think weighs on central bankers the most.
So basically, if you disintermediate the banks, and the banks are not collecting, again using US numbers, 13 trillion of deposits, but only 12 trillion of deposits, or maybe 6 trillion of deposits, what are we doing to credit allocation? Because for 3 to 5 centuries, or certainly since the Industrial Revolution, banks form an important feature in our economy to promote the extension of credit. And we had this 6 or 8 lectures ago, this graph that in the US, debt to our economy is about 3.8, or 380% of our economy in debt. It's not all bank debt, but bank debt's a big piece of that. Can you move credit allocation away from the banking system? Well, the answer has got to be in some level, yes. But what are the pros and cons of doing that? It's not whether you can, it's whether it's a better system, a better economy, better growth with or without it. Sean.
I was just curious, can you use like different interest rates to kind of to represent different level of risk, and then use a differentiation interest point as a way to fund the corporates? They can get the loan from central bank, or they can get the loan from...
So the question is, could you use interest rates to try to do it, which leads us to design considerations, which is basically, I listed that, the last one. You could have a central bank digital currency that had 0 interest rate. Interestingly, we'll talk more Thursday, Sweden said no, they think they'd put an interest rate on it. But you could do no interest rate. And I'd like to hear your thoughts Thursday. Well, why'd Sweden come out there, and does that make sense? You could put limits or caps on it and say these are only low dollar accounts. You can only have X hundred euro or X hundred krona or Y number of dollars, and it's really just small transactional accounts equivalent to $20 bills, not $100 or 500 euro notes. So you can put limits or caps or no interest rates and so forth? Do you make it widely accessible and so forth? So there's all these design considerations, which I'm guessing, Rob, you've talked to a bunch of central banks. Where do they come out on these issues as you see it in 2018?
Yeah, you have a lot of different opinions on it. I think the limits or caps thing is a hard thing to practically implement. That was always the sort of skepticism around that. It's like if you have these accounts and you say, well, we're going to only have one per person, we're going to cap it at a certain amount of money, what practically happens in a run? I mean, is the government really going to say, well, no, you can't put any more? Like, there'll be a lot of political pressure in any crisis, so I think caps are not really seen as, like, viable. And then I think the interest-bearing thing is interesting. I mean, the only reason cash doesn't bear interest is because it's, like, technologically difficult to make a paper instrument bear interest. So I think with digital currency, they might as well, you might as well give yourself the option, say, yeah, well, we can set the interest rate to 0 if we want to, but why limit yourself to say, well, we won't charge interest? Because again, it's like that's a limitation that comes from the technology of physical banknotes, and there's no real need to import it into the digital world when you can achieve the same effect by just setting the rate to 0 if you want to.
And one of the reasons that some countries are exploring this option is they think it would be easier to do monetary policy because you could have negative interest rates. Physical cash makes it hard for, yeah, nobody liked that, huh? No, the Tuolians, you don't like negative interest rates? But for a while, we effectively had negative interest rates, certainly for corporate deposits. But if everything was digital and there was no physical cash, central banks say we could actually go and have no lower bound, no zero bound to interest rates.
I guess in a way you don't necessarily need that, because if you can just create more money and pump it into the economy, it has the same effect, right?
Right. So what Rob's saying is you could affect that by supply of money rather than the pricing of money, and so there's both. One of the most interesting to me is the second bullet point. Is it token or account-based? And the two merge together in a sense. This piece of paper is a token. Nobody's keeping in an account that when I hand this to Rob, here, you can take it, Rob. Yeah, that's your fee, remember? So that's a token-based bit of money. That's what it's called, token-based. Token-based money is more anonymous, and you can keep it more anonymous. Account-based is when you're actually keeping the ownership somewhere on a registry. Even though that $20 bill is registered somewhere, it has a serial number, it's a token-based bit of money. The Swedes, interestingly, say they'd have to change the law, their own central bank laws for one of these two, and now I can't remember, but they have. If it's token-based, it would come under their e-money laws, and I think they don't need to change the law to do that. But in Sweden, they would have to change their central bank laws to do e-deposits, because they would literally be opening up their central bank to something other than commercial banks. That's it. They have to go to their legislative body in parliament to actually do an account-based and not a token-based, if I recall. So there's some also legal reasons why you might need to do one or the other, but one would have more anonymity than the other.
I think it's worth noting on this token versus account model is it's not well defined what people mean when they say token and account. So different central banks will say this and mean different things. And also people who work on Bitcoin will think about. So when I see token, I think about a particular structure of transactions, which Bitcoin has. And when I think about accounts, I think a structure of transactions that Ethereum has. And that's how I distinguish between those two things. But I think having spoken to different central bankers, they think about it differently, because e-money is like, you could think about it as, I mean, to me, that's an account-based system. So it's, but some bankers think about, so some central bankers think about that as token-based. So it's worth noting that the definitions are very fluid in this area.
So we're going to save this for Thursday. I'm not going to go through this. It was in one of the readings. Garrett, who testified in Congress, was so popular with this, then the Bank of International Settlement picked up this thing called the money flower But I'm going to save this. I'm going to kick this to Thursday. But it's basically the four things. Widely accessible. Is it digital? Is it central bank? Is it token-based? And depending upon where these intersect, you can take any form of money. You could say, well, it's not central bank issued. It's token-based. Private digital tokens is down in the right-hand corner is one little piece of it. It's just a way to take these four important features. And we already have central bank digital money, which is in the middle of all this. It's called reserves. But we're gonna hold this for Thursday. But this crazy little money flower, central bankers who are in this world, they kind of been using this because this Professor Garrett came up with it. I mean, I've seen this in other papers. They love it.